Today, we are going to crack the code on financial accounting. And look, let's just forget about the scary spreadsheets for a minute. We're going to explore how every single business, big or small, tells its financial story, who's listening in, and what rules they all have to play by. So, let's get into it.
At its heart, accounting isn't really about complicated math. It's a universal language. It's the script that every single business, from the coffee shop on your corner to a giant global corporation, uses to communicate its financial health, its performance, and, at the end of the day, its value.
And that's the real question, isn't it? Any language exists to tell a story to an audience. So what exactly is the story that a company's finances are telling? And maybe more importantly, who is actually listening?
Okay, so here's our game plan. We'll start with the language itself, then get into why it matters so much and who's using it. We'll cover the core rules, the whole process from a single transaction to the final report, and we'll even zoom in on a key concept like depreciation. Then we'll wrap up by looking at how this all applies to you. So, let's dive right into our first topic, the language of business. The best way to think about it is as a standardized system, one designed to tell a single clear story, the financial story of an organization.
Now, the official definition might sound a little academic, but it really just boils down to 3 simple steps. First, you identify some kind of economic event, say making a sale. Then you measure it, you put a dollar amount on it. And finally, you communicate that information through reports. The whole goal is to turn business activity into clear information that helps people make smarter decisions.
Which brings us to a really crucial question. Who is this financial story for anyway? Well, as you're about to see, the audience is actually way wider and more diverse than you might think.
This diagram shows the whole accounting cycle, but I want you to look over on the right, under Output. See those 2 categories of users, internal and external? From the board of directors inside the company to investors and government agencies on the outside, all of them are relying on this process to make some pretty big calls. So we can really simplify this by splitting them into 2 groups. First, you've got your internal users. That's a team inside the company, the people making the day-to-day decisions. And then you have your external users. Those are the outsiders who need to know if the company is a good investment, if it's a reliable partner, or if it's paying its fair share of taxes.
Now, for any language to work, it has to have rules. It needs a grammar. In accounting, these rules are called concepts and principles. They're what make sure every company tells its financial story in a consistent way so we can actually compare apples to apples. Let's look at 2 of the most fundamental rules of the game.
First up is the entity concept, and this one is absolutely crucial. It basically means the business is its own person, financially speaking, so a founder's personal grocery bill is not the business's expense. This separation is what lets us get a crystal clear picture of the company's health without any outside noise.
The second one is the dual aspect concept, and it's the bedrock of all modern accounting. It says that every single transaction has 2 effects, which keeps the whole financial equation in balance. It's like Newton's law for money. For every action, there's an equal and opposite reaction. This means what a company owns, its assets, must always equal what it owes, its liabilities.
This balance sheet shows that concept perfectly. Okay, so an owner invests $700,000. If you look on the right side, under assets, the business now has $500,000 in machinery and $200,000 in cash. Now look to the left under liabilities. The business owes that $700,000 back to the owner as capital. Both sides add up to $700,000, perfectly balanced.
Okay, so now what happens next? The owner takes out $5,000 for personal use. Notice on the right, the cash asset drops down to $195,000. And on the left, the capital owed to the owner also decreases by $5,000. Both sides now equal $695,000. The equation stays perfectly balanced. This is how every single transaction gets recorded. So, we have the language and we have the rules. But how do you actually go from one single sale to a full-blown financial report? Well, that happens through the accounting process. You can really break this whole process down into 4 key stages. It all kicks off with recording every single financial transaction. Then you classify them, putting all the sales together, all the expenses together, and so on. Next, you summarize all that classified data into the main financial reports. And finally, you report and communicate that story to everyone who needs to hear it. Now, this diagram here shows a more detailed, kind of formal version of that same process. It expands our 4 steps into 6 by adding in analysis and interpretation. But the basic flow is exactly the same. You're taking raw economic events and systematically turning them into clear, useful information. To really see these principles in action, let's zoom in on a really common and important accounting practice: depreciation.
Think about it. When a company buys a big, expensive machine, it wouldn't be very accurate to count the entire cost as an expense in just 1 year, right? Because that machine is going to be creating value for many years to come. So depreciation is all about spreading that cost out over the asset's useful life.
The most common way to do this is called the straight line method, and as you can see highlighted here, the formula is super simple. It's designed to give us a fair annual expense. You just take the asset's total cost, subtract what you think you can sell it for at the very end, that's the scrap value, and then divide that by how many years it's going to be useful. Let's see it with some real numbers.
Okay, so let's walk through an example. A company buys a generator. Now, the total cost isn't just the sticker price. It includes everything to get it up and running, like transportation and loading. So our starting number for this calculation is $510,500.
Next up, the company estimates that after its useful life, let's say 10 years, they can probably sell the old generator for parts for about $60,000. That right there is our scrap value.
So you take that total cost, subtract the scrap value, and divide it all by 10 years. The result is $45,050. This is the amount the company gets to record as an expense each year, and it gives a much more accurate picture of its profitability over time.
And that brings us full circle. We've seen that accounting is so much more than just crunching numbers. It's a powerful language for telling a financial story, and it has its own audience, its own grammar, and its own process for turning raw data into real insight.
So, the last thought I want to leave you with is this. Whether you're an investor, an employee, or maybe a future entrepreneur yourself, understanding this language is like having a superpower. It lets you look past the headlines and read the true story of any business. So the question is, what stories will you now be able to read, understand, and maybe one day even write?